Welcome back, everyone. I'm going to give you all about 10 to 15 more seconds to come back. Um, Thank you for those who have rejoined us for part two, our next session, and also making sure that you are on mute for us. We are going to get ready to transition into our next session. Um, and we are ready. Okay, awesome. Welcome back. Our next session's presenter is Keith Phillips. He is the Assistant Vice President and Senior Economist at the Federal Reserve Bank of Dallas. For those who are joining us on this portion who've just come back, who weren't here earlier, and just as a reminder, we just ask that you please stay on mute. We will take questions at the end of the session. If you have a question, drop it in the chat box. Our team is monitoring the chat throughout the presentation, and we will be able to share your questions with our Q&A moderators. If you're experiencing any technical issues, please send a private chat message to Catherine McClellan and we will do our best to assist you. Also, for those of you who'd like to receive CPE credit for today's sessions at any time, you'll need to complete the survey at the end of each session. So with that in mind, let me introduce Keith. Keith joined the Federal Reserve Bank of Dallas in January 1984. His areas of concentration include regional economics and economic forecasting. Over the past 16 years, he's been the most accurate forecaster for Texas job growth in the Western Blue Chip Economic Forecast. He teaches courses in managerial economics and quantitative analysis in the Executive MB program at UTSA. He obtained his PhD in economics from Southern Methodist University and holds a BA and MA in economics and a Bachelor of Journalism degree in news editorial from the University of Missouri at Columbia. We are thrilled to have Keith. And Keith, I'm going to turn to
All right. It's a pleasure to be here today. I always like giving a presentation to teachers, since teachers tend to be a little more interested in the material than others and tend to ask good questions. Not to put any pressure on you, but so I enjoy it. And, when I was, Morgan asked me to do this today, I was not too sure the kind of level of the presentation, if it was going to be more like a general public or more like an academic. So, I tried to keep it fairly top level, but kind of introduce you into the sausage factory a little bit on how some of this data that we produce during the pandemic was created, some of the issues that came up, and kind of how we utilize it more kind of on a realistic basis than just kind of presenting the index and how great it is. So to start, I thought since I'm doing a data presentation, I thought I'd tell you the story. It reminds me of the story of two economists that were out hiking in Big Bend, and they're out there all day, and they realized after a day of hiking they were totally lost. So one of the economists turned to the other economist and said, "Can you figure out where we're at?" And so the economist takes out a map, and he's looking at the map, and he takes out a compass, and he's looking at the compass, and finally takes out a GPS. And after about 10 minutes, the economist says, "Hey, after looking at all that data, have you figured out where we are?" And he said, "Well," he said, "see that hill over there?" He said, "Yeah, that's where we're at." So just because you have a lot of data and even more sophisticated data, it doesn't mean you actually know where you're at. And so we constantly try to get as much data as possible to kind of look for a consensus of what we have. Obviously, and we talk to a lot of business people too to try to figure out where we're at, and we need to know that before we figure out where we're headed. So anyway, it reminds me of another story. If you want to hear another story, thing about Zoom, you don't know if anybody's laughing or not. So, but anyway, I'll tell you a second story. This guy goes out one day and he's in a hot air balloon, and everything's going great, and all of a sudden these gale force winds come up, and it blows him way off course. So, but he comes over this ridge, and he looks down. There's a guy standing in the field, and so he yells down to the guy, "Hey, can you help me out? Can you tell me where I'm at?" And so the guy looks up. He says, "Yeah, I can help you out." He says, "You're about 70 feet off the ground, and you're in a hot air balloon." And so the guy in a hot air balloon says, "Hey, are you an economist?" The guy says, "Yeah, how'd you know that?" He said, "Well, the information you gave me was exactly correct, but totally useless." So sometimes just to get more accurate data, we just get data that's not very useful. So anyway, after beating myself up and reducing all credibility, I will present to you this presentation on one of the new measures we created during the pandemic called the Texas Weekly Employment Index. So I'm going to share my screen, and let's see. All right. Hopefully you see that. And so I kind of am not the kind of guy that likes to come up with fancy terms for things, but I did start calling this uh, particular downturn in the economy and how we study it Pandenomics. Kind of a funny term, but it's really it signifies that it's really different. It's more like a natural disaster, but a natural disaster that can reoccur over and over. I guess it's like an earthquake with kind of constant aftershocks. But you know, we had all these models that we use. The thing about a normal downturn is it's more like a barge, the way the barge turns, and this was more like the barge falling off a cliff. Uh, but so when it, you know, last year in April, we had this huge decline, and almost every economist expected May, the following month, to also decline. That's how recessions go. The first month is decline and more declines, and it gradually dissipates to flatness, and then it starts increasing. Well, so everybody's thinking May was going to be another decline, and guess what? May wasn't a decline; it was a big old bounce back. Not nearly enough to recover all the jobs lost, obviously, because we're not even there yet. But there was a bounce back and then recovery. So everyone was caught off guard, and we decided we need more timely indicators of the economy so that we're not caught off guard again. If you know, when these surges occur in COVID, the economy can suddenly change because everyone kind of goes home and stays home. So we needed more timely measures, and we call these timely measures high frequency data. That's a fancy term for meaning it's not monthly or quarterly, but weekly or daily. That's what high frequency. It comes out a lot, and so anyway, this is kind of the opening slide just summarizes what I was going to say, but that I've started to say already is so going into the pandemic, the Texas economy was in good shape, as well as the national economy. If you remember, we had historically low unemployment rates in the U.S. We had the longest expansion in U.S. history. Things were quite good, but all of a sudden COVID hit. Of course, we had, if you remember back in the beginning, we are going to shut down the economy, and then you know, the COVID would kind of come to a halt, and by August of 2020, basically COVID would be gone. That was the plan, and it did not work that way. But no matter what the level of COVID was in your state, everyone kind of shut down for a while, hoping to reduce the spread of COVID. So there was a sudden, sharp contraction in the economy that no model would have forecasted. Nobody in January was forecasting a huge decline in the economy in April. So, and then when you got this big decline, almost every time series model we have expected more declines to come. And that didn't happen. So we had to kind of throw out our forecasting models, and we had to kind of search for data that can tell us more timely what's happening instead of waiting for monthly or quarterly data to tell us what has already happened. So we came up with this weekly employment estimate. So this is just to show you kind of how this recession differs from past recessions. This is job growth that is indexed to the peak of job growth, looking at past recessions. So these are Texas recessions, not US, and this is Texas job growth. And so you can see they all equal each other at zero, meaning the peak of the economy, the peak of employment. And these covers recessions going back to 1982, 1982, 86, 2001, 2008. 2008 was a great recession. You can see it dipped down more, but you can see that this thing doesn't look like any of them with that huge decline and then the bounce back that occurred. But by this should go out to April, at least. It may go to May. It should be updated to May. So by 15 months after the peak, we're now about where we were kind of on average. So jobs now are below the peak at about the same rate as 15 months later as past recessions. But how we got there was very different with the big decline and then the gradual increase. But right now we're kind of, you can say where we are in terms of jobs is typical of past recessions, but obviously the path to get here was very different. And just for fun, I plotted Louisiana jobs after Hurricane Katrina hit, and that's that green line. And you can see the path of employment from peak to trough and then expansion looks pretty similar to what happened when Katrina hit. Now, I had to use Katrina because Louisiana as a state was hit. You know, a lot of its activity is in the coast, particularly in New Orleans. So the state was hit dramatically. Really, Texas hasn't had any big thing like that. Harvey didn't hit the state anything like this. It hit the Gulf Coast and Houston hard, but anyway, so this was like a major hurricane or a major weather event hitting the whole country really at once. So anyway, it's quite different than normal type of business cycle activity and requires a little bit different measurement. So right away, we decided that we needed to kind of come up with some new data, and we needed to monitor the data and monitor the economy more frequently than just monthly or quarterly. So this is the regional dashboard that we put together for our bank president, Rob Kaplan. So he can, well, it's for him, obviously, but we also use it, obviously, too, to monitor the economy. And these are some of the data that we look at. You can see up in the top left is COVID cases in Texas, 7-day moving average. That thing has fallen dramatically since January, thanks to the vaccines hitting the economy. But recently, it's stalled out. Actually, in the our forecasting model that we use, we don't use COVID cases because there's a lot of lumpiness in the data that, you know, some holidays and other things cause the reporting to, you know, be low for a couple of days, and then all the reporting comes in and then it shoots up. So it's very lumpy, whereas hospitalizations show the same trend, but they tend to be measured much more accurately. But here we show cases, and you can see it's flattened out, and hospitalizations in our forecasting model expected to actually increase somewhat in the third quarter because of the spread of the Delta virus or Delta variant of COVID that's spreading throughout the country. It's more contagious, and Texas is behind in terms of vaccination rates. So those not vaccinated are more likely to catch COVID. And as COVID goes up and down, the economy strengthens and weakens. So, uh, 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 there's some question if that relationship will be as strong going forward, but we'll see. Uh, so on the top right is the weekly. I got to monitor my time here. I think I got to go pretty fast. So spent too much time on jokes. So anyway, there's several measures here. I'm going to get in the weekly employment estimate. We got some census hiring data that's sporadic and somewhat volatile. The home-based data we get from the software company that measures people clocking in and clocking out at small businesses. And that's been a really useful series to us. Debit and credit card spending from Affinity Solutions. It's about 10% of all debit and credit card spending, and that's above where it was pre-COVID now. Dining out, we measure from Open Table, which is, so this is dining, it doesn't include drive-through or anything like that. Okay, I just got a text from Morgan. I got till 10:30. And then weekly initial jobless claims have been falling, and the rig count has been rising. So we give this to our bank president every day at the end of the day. We have one for the macro side, and this is our regional side, along with all the sources of the data. So we had all this new weekly data, and it was like, oh, well, this is going up, and this is going down, and this is going up, and this is going down. How do we summarize it? I mean, Rob likes data, but he likes the bottom line more than a bunch of, 10 different indicators going all different ways. So we needed a way to summarize the most important weekly indicators into kind of a bottom line. And the best way to do that is to link it to something else that's more that we're used to looking at as a broad measure of the economy. So, at the national level, the most common series people look at is GDP, but that series is lagged and less well measured at the state level. So we use employment. Employment is very broad, very timely. You can get it for the different areas and the different industries. So we used to looking at the Texas economy through job growth. And so we decided to take some of these weekly series and look for the common code movement of the series and then link it to job growth so we could get a weekly estimate of job growth. So when we say weekly employment estimate, we're not counting jobs. We're not going out there and trying to count the number of jobs on a weekly basis. What we found is that looking at all these weekly indicators, that their code movement kind of, if you look at it relative to job growth, it's very highly correlated. So then we can take statistical estimation using this weekly code movement series and tie it to job growth to get a job growth estimate. So here are the series we use. We use initial jobless claims, people filing claims for unemployment insurance. We use debit and credit card spending overall and at restaurants. And the most recent 2 weeks, I think, is missing of this debit and credit card spending. So for that, we use the open table for the most recent 2 weeks. And then home base says how many hours are these workers clocked in and clocked out, and we use that. And then the rig count. The rig count is I don't know if we should have it in there or not, to tell you the truth, because you'll see in a minute, it doesn't really move with the other indicators. We like to use it because oil and gas, while not a big share of the economy directly, is a pretty big share of the economy indirectly, because a lot of manufacturing is involved in making stuff for the oil and gas sector. And a lot of, Houston Houston, which has 25% of all jobs in the state, is still reliant. Not, it's diversified, but it's still oil and gas is important, and it's certainly important out in West Texas. So we also include the rig count. We have that weekly. So, and then we use a mobility engagement index, which is really interesting. We had this at the Dallas Fed because the SafeGraph data was available. It's no longer available, so we're substituting a Google Mobility Index. But people know where you're moving. People know when you're driving or staying home, and it's not, obviously they don't release any individual data, but they can track movements of people. And this mobility of people through their cell phone tracking can show if people are going to work, they're going to the store, they're going to parks, and how they're moving around. And you can aggregate these series into mobility that's most related to economic growth, and then use that. And we use that also. So the weights, this is just kind of what this statistical method called principal component says. How do you weight these things to get an underlying code movement that reduces the differential between all the series the most? And it gets pretty equal weights, except for the rig count gets a very small rate, and it's actually not even the right sign. So we may eventually throw the rig count out of there. So these are all the series that we use. The black line is this kind of principal component index. It's not taking the average of all the series, or else this black line would be in the middle. But it's first converting all these series into growth rates, and then taking the not the average growth rate, but what a growth rate needs to be to minimize the distance between that line and all the other lines. That's what a principal component does. But anyway, you can see it moves pretty similar, except for this purple line. That's the dang rig count. Let me go back. I was going to delete that purple line, but I don't think I can in production mode. But anyway, so one interesting thing is you can see Winter Storm Uri here, and how this weekly data, most of all of them, and the aggregate index fell during the winter storm, but it bounced back right away. So we're able to use this weekly data to know that the impacts of the storm was very temporary, that a week later activity was back up to normal, because we didn't know how much damage was done to businesses in terms of pipes and things like that. So it's pretty interesting. But you can see all these series, they don't always move the same, but in general, they move in a pretty consistent way. So we have this, let's see what time it is. I got 5 minutes. So this weekly, so in converting the movements in this baseline index that is kind of the code movement, all those series, into a job series, we created this blue line by regressing the baseline on monthly job changes, and you get this blue line. Well, the green line is a 2-week smooth thing, because the blue line, so employment, this is one of the nuances in the sausage factory. Jobs are measured, they ask employers how many people you had on the payroll for the week that includes the 12th day of the month, right? So at first we created this, we measured job growth for only how the thing moved between the weeks that include the 12th day of the month. And that thing worked okay, but it turned out to be way too volatile, because this stuff is pretty volatile. And it's not the week that includes the 12th day of the month, actually. It's the payroll that includes the 12th day of the month. So they ask employers how many jobs you had on the payroll for the payroll that included the 12th day of the month. And some companies pay every 2 weeks, some companies pay monthly, a lot of companies pay weekly. So anyway, we fooled around with it and found that the 2 week smooth. So if we take the week of the 12th day and average it with the prior week, you get a much more accurate, actually, measure of job growth change. So anyway, we looked at different ways. The centered 3 weeks of this index are the 2-week average, and the 2-week average work best. So here is monthly job growth, which is purple bar, and then this 2-week smooth is the blue bar. So this is the blue bars. This is real time. What does real time mean? It means that this was what we had before the employment data was released. So if you look at this blue bar, it is what we estimated that job growth would be before job growth came out. So a week or two ahead of time, we estimated it based on the tweet. So you can see the red bar was if we just use the week that includes the 12th day of the month. The blue bar is much more accurate. But you can see it's not perfectly accurate, but it does seem to measure the ebbs and flows. So over November, December, and January, job growth kind of was flat. Well, it kind of grew a little bit, and we said it would not change much, but we overestimated job growth. But then in February, during the winter storm, it was pretty good prediction that it would fall. So we knew ahead of time that it would fall. And then we knew March was going to be very strong, and April was going to be weak. So I did these slides. I had to update them this morning because last Friday the employment data came out, and this 2-week estimate of said job growth would be here, and job growth was here. So I don't know if hopefully you see this arrow moving around, but so it was, we did, it tends to show if job growth is weakening or picking up pretty accurately, but it doesn't really accurately say, it's going to be 3% and it's 3%, but it does measure if job growth is weakening or strengthening. So it's a concern right now is that we have just gotten kind of the second week of June weekly estimate. We won't get the employment data for June until the 3rd week of July. But so far, it's not looking good. We had expected job growth to really accelerate as COVID came down. Job growth has been pretty mild, disappointing in April and May. And June looks like it could be pretty weak. I'm not going to say June is going to be negative, but it's likely to remain weak. In the next couple weeks, we'll get more revised data for June, and we'll see what happens. But so far, it looks like June is not going to be a big jump in job growth. So I think this is the summary. So we made high frequency data. It became very essential. To do our weekly. Well, first we had daily briefings with our bank president, Rob Kaplan, and we had to have new data. So it was important to seek this high frequency data. And then we went to weekly. Now we're kind of at bi-weekly, where we brief them on what's going on. So we aggregated these data into this weekly employment estimate. We had suggested that May, which came out on Friday, was going to be pretty similar to April, and it came in that way. Although the growth rate was not what was predicted, kind of the pattern of growth was pretty close. And unfortunately, the early estimate of June right now is quite weak. We're waiting for takeoff, and hopefully we'll get it in July. So we have, I think you guys get all this stuff through all that other stuff, but we have links in here to some of the stuff we do, the COVID related stuff on the right. So I think I'm at 10:31, so that's pretty close. So do you want me to stop sharing?
Yeah, that would be great.
Okay.
Well, thank you, Keith, for presenting. It's always a pleasure to have you and to hear your jokes. I know that we had some reactions that were going on, whether it was thumbs up. So we did have people that were listening to those jokes. I know that we're all on mute. But thank you once again. For those of you that I have not met in person or virtually, I'm Morgan Ackley. I'm one of the economic education advisors in Dallas. I help to write curriculum for economics, financial literacy, as well as college and career readiness. So I am going to go ahead and get started with the Q&A portion of our program. So please feel free to drop any questions that you have for Keith into that chat, and we will ask those questions as they come in. Before we get started, I know I have a couple questions that are already coming in. Keith, I have one question for you, really around the geolocation data that's coming in. And how do you think this might impact the field of economics going forward? So Keith, I think you're on mute.
Okay, can you hear me? You can't hear me?
Yeah.
All right, I muted and unmuted, and that seemed to work. So that's a good question. I've been asked that before on by the media, but it's not like it changes the field. It what it does is kind of gives us more tools in the tool bag. I have to say, on a general basis, you have to worry about overload of information, and on a daily or weekly basis. I mean, if you just kind of watch, oh, yesterday the economy improved, and today a weekend, and yesterday improved, it's like, well, where are you going? I mean, you lose track of there's a lot of noise in daily and weekly data. So but it's very useful, particularly when the economy does change quickly, and that's during pandemics, but it's also, and hopefully won't have another pandemic in my lifetime, which is not that long. But but we will have hurricanes, and we will have all kinds of weather-related things, so we can monitor and see, is Houston coming back from this next hurricane quickly, or is it taking longer? So this weekly data helps us in terms of monetary policy and kind of broad, traditional, historic recessions and expansions. They'll play a much smaller role than the large aggregate data, because monetary policy doesn't even change based on monthly data. It's more of a broad range thing. Inflation picked up recently, and everybody's all excited about that. But the Fed is looking forward to what's going to be inflation next year in order to change policy, but not kind of how inflation changed yesterday versus today. So I think it's a great addition to our tool bag of understanding the economy, and in particular important when you have rapid changes in the economy due to things like weather events. So that's my answer, and I'm sticking to it.
Perfect. We'll take it. It's exciting to kind of see how this data is being used, and even how you had to switch during the pandemic to using that high frequency data to really get a grasp. We have a couple questions in here, and the first one comes from Dan, and his question is, how influential is the WEE in forming the 11th District's entry for the Beige Book? And then the second part to that, what accounts for the discrepancies between the WEE and the BLS figures?
Yeah, so the first question is, the Beige Book is an anecdotal summary of what we're hearing from our contacts. So the we doesn't go into that. So we have two sides of information that we get. One is through the data, the hard data that we get on employment and all the stuff that I went through. And then we call contacts. We call businesses throughout our district for our business outlook surveys that and through our board of directors meetings and through roundtables, and we do all kinds of stuff like that. And all that stuff filters in the beige book. So it's more of what we're hearing from our contacts. So it doesn't go directly into that. So why is our we estimate, why does it not totally accurate? If you worked with data for a long time, you know it's never totally accurate. Even the employment data that so we'll say, well, you know, we expected like 4% growth in April, and it was only 1.3. So why was it so different? Well, for one thing, that 1.3 got revised the next month to 2.5, by the way. And then later on, they're going to benchmark that data, and it can be revised again, right? So there's error on both sides of the equation. That's going to be, this data is never firmly built and firmly on solid ground for a while, because the BLS will, it's originally a survey, but later it will be benchmarked to the data that's filed for unemployment insurance, which includes like 98% of all jobs. So it becomes almost a total count, but that won't happen for another year. So it could be the employment data is actually wrong, but there's also obviously, we're using a bunch of hodgepodge of weekly indicators. Like the home-based data is great because it measures people clocking in at small businesses, a lot of retails and restaurants. But that's only a small part of the economy. It's not measuring like big firms and things like that. But it has information in it. And then, you know, initial claims for unemployment insurance is broader, but it doesn't measure job growth, only one side of the net job growth, which is people that have lost their jobs. And if you quit your job, you can't get unemployment, only if you get laid off. So there's all these nuances. So we never expect it to be total accurate, but if we can kind of, if it's a good indicator that job growth is picking up or slowing down or going negative, we're pretty happy with that. And it seems to be working pretty well in that regard.
Well, thank you, Keith, for that. And we do have another question from Lydia. It says, can you share your thoughts or expectations for September, taking into consideration two issues, a possible third wave of the Delta variant and the ending of the COVID-related unemployment benefits?
Yeah, that's the question of the day. That is what we're trying to answer for our bank president, and everybody's wanting to know. So in Texas, the federal benefits end on Saturday, this Saturday, because the governor signed that thing saying that we're not going to take all this money from the government anymore because it's hurting businesses. So so we should start, you know, we're doing our surveys right now. We're asking businesses, you see any loosening up of the labor markets? I mean, so first off, if you've been at home taking unemployment benefits, say you make $16 an hour or less working at a restaurant or whatever, and on unemployment you're making more than that, you're not seeking out a job, it's not because you're lazy, it's because you're being financially responsible. Because if you live paycheck to paycheck and you have an opportunity to increase the wealth of your family by not taking a job, I mean, that's your incentive. That's not being lazy. That's just being responsible. That's the way I look at it. That's the way I would do. And so there are certainly some people, a lot of people, I think, who are in midlife or older, are trying to take this time to really look for a job that might long-term benefit their lifetime earned income. And we hear stories of people doing this who have worked in restaurants and are now working at law firms as paralegals, or you can take a class or become an apprentice for a plumber or something like this, where you have a kind of a longer expectation of lifetime earnings. And this is a point in time where you can do that. Most of the time in the past, when you become unemployed, you can't. You don't have the time to seek out better a better job for yourself because you're living paycheck to paycheck. So anyway, I ramble, but these extra benefits are going away, including the extension of state benefits and the extra $300 are going away this Saturday. So it's very unclear the response. We think obviously we'll have some response that some of these people will then come out of not working and go in and seek a job. So employers have been telling us they can't find workers, and if you look at job openings, they're way high. So that should help quite a bit, but we're not exactly sure how. And then, as I said earlier, my forecasting model has hospitalizations in it, and because of the Delta variant, instead of kind of continuing to fall sharply, now hospitalizations are expected to increase slightly in the third quarter. And in the past year and a half since COVID, that meant that the economy is going to slow. But it's interesting because most of the rise in cases and hospitalizations will be among people that chose not to be vaccinated. But still, people who are vaccinated, when this thing starts to spread again, are going to be more hesitant about going around outside, even if your probability of getting it is low because you've been vaccinated. So I think the two things are going to, interact in opposite ways, but our forecasting model is expecting strong job growth in the second half. And so I think ultimately the opening up of the labor markets and continued demand for jobs and wage pressures going up will cause overall employment to rise in the second half.
Well, thank you, Keith. The next question had to deal with monetary policy and thinking about it of does this weekly data help to inform monetary policy? And it looks like the question was saying sometimes that weekly data may be used to, do for speculative purposes in the stock market, but is it being used by policymakers somehow?
I have not used it for speculative purposes in the stock market. I'm not smart enough to predict the movements in the stock market. But anyway, in a limited fashion. I mean, regionally, as COVID has changed in different regions of the country, different regions have gone into lockdowns and really you don't even need lockdowns. People will lock down themselves during these surges. So this weekly data informs monetary policy of kind of where different patterns of growth. So the Fed is, monetary policy is national, but the Fed was set up as a regional organization. We're the 11th district. And so it was set up that way so that DC wouldn't control everything based on what's going on in the Northeast. So when they go around the table, they're going to talk about different regions and how the economy is behaving recently. And so the bank presidents will report on the region, Rob reports on the 11th district. And so it'll be saying, well, this is happening. And so we'll get a closer view of the economy if any dramatic changes occurring. And in that regard, it can affect some, elements of monetary policy. But once again, it's extra tools in our tool bag, but it's not going to be the primary thing that monetary policy looks at now. So it can be helpful, but there's a lot of other things we still rely heavily on, like monthly job growth and quarterly GDP growth.
All right. It looks like we have time for maybe one or two more questions. The next question says, how much of the data you presented is available on the county or city level?
Oh, that's a good question. Some of the data is available at the county level. The mobility data, the Google mobility data, I think is available at the county level. I don't think the city level. City data is much harder because it's a political boundary that changes all the time. county is a fixed definition of a geographic entity. So more data is available by county than city. And I think the mobility index is, I think the Workforce Commission was releasing initial claims by county for maybe not all counties. They have to have enough data series so they're not releasing private information. But for a lot of counties, I think the unemployment claims are available. Um, I don't think the home base. So those are the two series that I know about that are likely available by county. But I don't. There may be some by city, but I don't know.
So Keith, I'm going to follow up with an additional question about the Google Mobility Index that you use with the Texas Weekly Employment Estimate. According to Google's Mobility Index website, it states that these reports will be available for a limited time, so long as public health officials find them useful in their work to stop the spread of COVID-19. How will the TWEE be impacted if Google discontinues its mobility index?
Yeah, so our first mobility index that was available through April was this thing produced by us, the Dallas Fed, and in conjunction with the New York Fed, called the um, what was it called?
Mobility Engagement Index.
Yeah, the MEI, the Mobility Engagement Index. Thanks, Morgan. And that was based on this safe graph data, which they were able to manipulate at a pretty fine level of geographic level. And then we had to, that SafeGraph stopped producing that data, and now we're using Google. And so Google, if it goes away, obviously we can't, well, unless some other source. There's a lot of apps on your phone that want to know where you're at. I use my Fitbit, and it's always constantly trying to get me to connect with my phone at all times. And once it's on the phone, then you know it can be tracked. But we'll have to play it by ear and see if we can get other data on mobility if Google stops producing theirs. So if not, then we move on to other things. So we would have to drop that from the index. And if enough other stuff, I don't know if I don't think home base will go away. But if it does, if enough things go away, we'll have to stop doing it. So we just have to, we're slaves to the data, I guess.
And I wanted to thank you for joining us today and having a candid conversation. Data isn't always fun, but somehow you've made it interesting and relatable. So I want to thank you and for our participants for asking some great questions in today's session. So thank you, Keith. I really appreciate you being here with us today.
Sure. And my only regret is not seeing all the teachers, because I tend to have a better interaction in a live audience with teachers. I really do enjoy presenting in front of them, because they're not afraid to give me crap and press me on things. But I appreciate it. So thank you very much.
Of course. And when we go back in person, we'll make sure that we invite you
Okay.
to come speak with our teachers. So as part of the program, if you're just joining us, our team wanted to take an opportunity to share with you of different resources or maybe even different teaching strategies that you could quickly either embed into your classroom or maybe extend the learning based upon what we learned about for Keith's presentation. I think there was a couple questions in the chat that kind of preface some resources that I'm going to share with you today. If you can go ahead and go to the next slide, please. Okay. So to start with, we know that we have a diverse group of educators with us today. So whether you're teaching college, whether you're teaching social studies, economics, or even a CTE course, I wanted to share some quick ways that you can just add to what you already might be teaching around the performance in the economy, as well as economic indicators that show up in lots of those different courses. So the first way that you can embed this content into your classroom is to have your students maybe make a prediction. Just like we've asked Keith to maybe make a prediction about what might happen in September, we can ask the same thing of our students. So what might happen to economic growth in 3 months from now? You can use that high frequency data that's found on the Dallas Fed website, as well as the Texas Economic Indicators or the Texas Weekly Employment Estimate, to really have your students take a look at this data and maybe make a prediction, an easy way to embed it into your existing course. If you're joining our program from today from New Mexico or Louisiana, or even the rest of the United States, some of that national data of the weekly economic index, as well as the US economy charts, my coworkers are going to go ahead and drop some of those links into the chat for you. Those might be great resources if you're looking at national data, if you're not from Texas. You could even give this assignment to your students as a pre-assessment at the beginning of the school year to understand what is their level or how familiar they are with economic vocabulary. So in economics, we know people respond to incentives. So you can always change this prediction into a competition and maybe give students awards or prizes of who can make the best prediction of what might happen 3 months from now. Another way to engage students in the classroom is to share how this high frequency data is gathered using geolocation data from cell phones. We heard Keith talk about his Fitbit, that it's connected to his cell phone. Every app that you download on your phone, for the most part, if you didn't read those terms and conditions, is tracking data about you. It might be a neat experiment to have your students survey their peers to see how many of their peers have that geolocation data actually turned on their electronic devices. Then you could always have the students tell that story using data visualization, so using charts or infographics. You can go ahead and go to the next slide, please. So an opportunity to extend this lesson is actually through one of the resources that we have. So we have a lesson that was written at the Dallas Fed, and it's a simulation called Take a Seat at the Table. So this lesson would be a great opportunity to extend your students' understanding of statistical information. If you're not familiar with the lesson or have not seen it yet, it gives students the opportunity to play the role of a Federal Reserve Bank president in an FOMC meeting by reading and evaluating the beige book, as well as students have the opportunity to conduct a discussion on monetary policy and write a press release. Go ahead and go to the next slide. So students are introduced to both upside risks and downside risks in this simulation. So risk implies that economic conditions could harm the overall health of the economy. And for the Federal Reserve, that risk assessment is related to conditions that could lead to missing maybe one or two of their primary goals, which is stable prices and maximum employment. Upside risk refers to those conditions that threaten stable prices. In particular, those events that could cause the overall price level to rise would be categorized as an upside risk. Downside risk are those conditions that could lower the employment or create unemployment. So the FOMC makes policy recommendations based upon the committee's assessment and balance of these two risk categories. And next slide. So this is just examples from the lesson. It gives you a kind of a preview into it as they're using that beige book to actually find some of that information to make informed decisions on their debate or their policy. You can go ahead and go to the next slide. So this is where we connect Keith's presentation and the information that he shared with us today. So as students go throughout the simulation, they're introduced to the Federal Reserve System structure, how the FOMC uses that anecdotal information contained in the beige book to inform policy. Students have the opportunity to read and evaluate that information from the beige book. But just like with most economic data, the information that is released in the beige book is also backwards looking. So it is released, or there's a delay to when the data or the information is written in the beige book until it's released. But as you can see on this slide, which is found in the lesson presentation, we can also measure the economy using both the anecdotal information and that statistical information. So the original lesson procedures only have students use information contained in the beige book to draw their policy conclusions from. Would be a great lesson to extend students' understanding of other economic indicators to measure the economy. Whether that's GDP, inflation rate, unemployment, or using some of that high frequency data to supplement their policy discussions that Keith mentioned in his presentation. So the Dallas Fed website has some economic data that includes that high frequency, regional, US, international energy data. It's really a one-stop shop for students to explore current data and historical data. The Dallas Fed high frequency indicators obviously provide that timely measure of activity, so students could use that to draw their own conclusions. So these are just some resources as well as links that hopefully might be helpful for you to either embed or extend that learning that happens in the classroom. I wanted to thank you again for joining the session, and also thanks for my team who has been able to share all the links to those resources that are in the chat today. For the educators who are joining us today and would like to earn the CPE credit for this session, there is a link to that survey that's in the chat. We will be taking a short 10-minute break, and we'll be back for our next session featuring our Dallas Fed Research and Studies Director and Senior Research Economist, Jason Savings. So sit back, relax, take a quick break, and we will join you in 10 minutes for our next session.